Next, capital asset pricing model. What is capital asset pricing model? Meaning, it is mean framework for evaluating any investment decisions. So I want to invest something. What is my decisions? Do I need to buy it, or do I need to buy it future, or do I need to sell it right now and buy it later? Development of formulate the return required by the investors. So I need 15% interest. So banks are providing 8%, we are going 15%, 7% more. How to get it? Such a way you should require or investors requirement, you should risk it out. Because 8% is risk free. You are going double the rate of return. That is highest risk. How to get that? Required rate of return is the minimum expected return. What is the minimum I can get? 8% I can get. So what is the maximum I can get? And how much risk are you to offer? Assumption, efficient market, whether market is efficient, rational investment goals. So, what is my goal over the period of time? All assets are liquid. So, even though I buy it today, how is liquid? How can I liquidate? Investors are able to borrow freely at a riskless rate of return. Whether that investor able to buy it, is that money is overflowing in market or less? That's the thing you want to see. Advantages: risk adjusted return, no dividend company. So if risk is adjusted return, so I'm getting good return and risk is much less, and no dividend company. They are not giving dividends, so the valuation of the value of the company is going up. Disadvantage and limitation. Reliability of beta. The beta formula what we give, it's not so reliable. And other risks, there are many other risks that may causes the company to fall in the price of the share. And information available. There is a restriction in information because not everyone will say what is a true. So always there is a restriction in the information. These are the things you should know about the capital asset pricing model.